As of right now, during today's live market trading session on August 4, 2026, KEEL Infrastructure Corp, trading under ticker symbol KEEL on the Nasdaq, is currently sitting at $3.97 per share, down 1.98% on the session. While a casual glance at the ticker on your Robinhood app or Fidelity trading platform might lead you to believe this is just another struggling small-cap penny stock fading into irrelevance, the actual reality unfolding behind the order book paints a wildly different picture. Mainstream retail investors see a company that has taken a severe beating over the last month, down more than 27% from its mid-summer peaks. The narrative on popular investing sites and message boards is that KEEL Infrastructure Corp is failing to execute its transition from legacy cryptocurrency host to high-performance computing provider. But what if the market is mispricing the raw megawatt capacity sitting directly on KEEL's balance sheet? What if Wall Street is evaluating this ticker through the old lens of digital currency mining, completely missing the fact that tech giants are starving for gigawatt-scale grid connections? The market narrative right now is simple. Traders look at the trailing 12-month net loss of nearly $290 million and assume this enterprise is a capital burner with no path to durable profits. When people check their individual brokerage accounts or search for self-investing options, they see elevated volatility, heavy short interest, and a stock price that has given back a huge portion of its recent gains. That is the expectation. The general consensus is that building AI-ready data centers requires tens of billions of dollars, and a smaller player like KEEL Infrastructure Corp will get squeezed out by massive real estate investment trusts and well-funded cloud hyperscalers. However, the reality is far more complex and intriguing. The bottleneck in modern technology is no longer the availability of chips or capital, it's the physical availability of high-voltage electrical grid interconnections. Big tech companies can order millions of advanced processors from NVIDIA stock, but those chips are useless without dedicated substations and gigawatts of firm baseload power. KEEL Infrastructure Corp holds secured grid access and energization pipelines totaling over 2.2 gigawatts across key power markets like Pennsylvania, Washington, and Quebec. In an environment where utility interconnection queues stretch 6 to 8 years out, owning energized land with existing transformer infrastructure makes KEEL less of a traditional software or hosting business and more of an ultra-scarce energy gateway. Looking closely at recent trading action, the stock has experienced massive institutional positioning changes over the last several quarters. On standard trading interfaces like Interactive Brokers or through Fidelity brokerage accounts, volume indicators show heavy accumulation spikes on pullbacks, followed by sharp retail sell-offs whenever broader market tech indices pull back. Over 39 million shares traded hands today, well in line with its 45 million average daily volume, highlighting intense liquidity and active repositioning by major funds. While short-term traders on the SoFi trading platform or Robinhood stock trading modules might be spooked by daily 2% dips, institutional holders in funds like the CoinShares Bitcoin mining ETF and various Vanguard small-cap index funds are holding sizable positions. They recognize that power asset valuation metrics are shifting from simple price-to-earnings calculations towards capacity value per megawatt. To understand why this stock moves with such extreme volatility, you have to look at how earnings reports have hit the market recently. In its last quarterly release, KEEL reported revenues of nearly $37 million, beating consensus estimates. Yet the stock sold off aggressively because net loss figures came in wider than anticipated, driven by non-cash impairment charges and aggressive capital expenditure commitments required to upgrade site infrastructure. The market punished the headline bottom-line number while ignoring the top-line beat and the operational progress made in securing additional expansion capacity. Investors using self-investing platforms or checking Fidelity IRAs often overreact to backward-looking gap losses, ignoring the intrinsic asset value of transformer capacity in high-demand regions like PJM in Pennsylvania. Macroeconomic pressures have also played a major role in keeping the stock suppressed near the $4 mark. High interest rates have raised the cost of project financing across the entire infrastructure landscape. When debt becomes expensive, building out massive substation expansions and cooling systems for high-density compute clusters costs significantly more upfront. This interest rate drag has weighed heavily on mid-cap and small-cap infrastructure tickers across the board, causing retail investors using online investment tools or SoFi active investing accounts to cycle capital back into mega-cap safety plays like Tesla stock or Apple stock. However, as rate expectations stabilize, capital is once again seeking high-yield infrastructure growth opportunities. Now, let's break down what KEEL Infrastructure Corp actually does and how its core operational model functions. Originally built around cryptocurrency hosting and high-density compute infrastructure, the company operates major power and data campuses including Scrubgrass and Panther Creek in Pennsylvania, Moses Lake in Washington, and Sherbrooke in Quebec. Historically, these locations provided computational power for blockchain validation and commercial electrical services, but as artificial intelligence algorithms demanded unprecedented amounts of electricity, KEEL recognized that its real strength was not in processing specific tokens, but in owning the power substations, high-voltage transmission tie-ins, and land required to host high-performance computing hardware. Their current operational model centers on converting legacy industrial and energy sites into purpose-built high-density data campuses. They secure land, manage the local utility relationships, build out fluid cooling systems, and deliver energization directly to enterprise clients and hyperscalers. Operating in cooler northern climates like Quebec and North American power hubs gives them operational advantages using ambient temperature cooling to reduce overall power usage effectiveness ratios. Instead of competing with chip manufacturers, KEEL provides the foundational energy floor without which high-performance clusters cannot run. If you're following this analysis closely and evaluating your options on platforms like Schwab Intelligent Portfolios or SoFi Invest, drop a comment below right now and let me know how many shares of KEEL Infrastructure Corp you hold, or share your thoughts on whether legacy power sites will win the race for AI compute capacity. Your comments help gauge sentiment across retail and institutional investors alike. Looking ahead, the future outlook for KEEL Infrastructure Corp hinges on a dramatic tension between market expectations and execution reality. Wall Street expects KEEL to burn cash while struggling to sign long-term master service agreements with major cloud providers. The pessimistic view assumes larger competitors with deeper balance sheets will build out new power generation faster, leaving small-scale developers behind. If KEEL fails to finalize major enterprise hosting contracts or encounters delays in transformer deliveries, the stock could easily retest lower support levels. The counter-narrative, however, relies on power scarcity reality. Electric utilities across North America face backlogs stretching several years just to approve new grid connection requests. KEEL already possesses 341 megawatts of energized capacity and over 400 megawatts of secured capacity, with a total expansion pipeline reaching 2.2 gigawatts. In the infrastructure space, time to power is the ultimate competitive advantage. If a major tech platform needs 200 megawatts online next year, they can't wait 5 years for a greenfield utility interconnection. They have to partner with or acquire companies that already have energized plugs in the ground. That reality creates a massive floor under KEEL's valuation that simple earnings metrics fail to capture. For anyone managing an intelligent portfolio or exploring online investing opportunities across Robinhood Investments, SoFi stocks, or interactive broker setups, KEEL Infrastructure Corp represents an asymmetric trade setup. On one hand, you have a stock trading under $4 with substantial headline losses and short-term pressure pricing. On the other hand, you have a rare portfolio of grid connections positioned in the middle of the greatest power demand spike in modern industrial history. In summary, the key takeaway today is that market expectations are entirely focused on past financial performance and temporary operational spending, while the reality is rooted in physical asset value and grid scarcity. KEEL Infrastructure Corp is not just navigating a business transition, it sits on top of gigawatts of energized real estate at a moment when electrons are becoming the most valuable resource in global tech. As you track this stock on your Fidelity mobile app or Robinhood app, remember that stock prices fluctuate on short-term sentiment, but long-term value is dictated by fundamental supply and demand. KEEL has the supply of power, and the market has an insatiable demand for energy. Whether that gap closes through long-term leases, strategic partnerships, or asset acquisition, the underlying reality promises to keep this ticker directly in the center of the infrastructure narrative.